So your financial capacity for risk. How much can you afford to lose? What's your net worth? What's your income? What are your expenses? There are really 4 different types of risk. This is an important page, 3-4. We have market risk, business risk, interest rate risk, and inflation risk. And let's evaluate each one of these. So let's look at a couple different investments and see what type of risk they actually have. For the people that like the bank, savings, CDs, and money markets, there is no market risk. You're not going to lose anything on it. There is no business risk. There's basically no interest rate risk, but there's definitely inflation risk. If I'm earning 1% on my CD and inflation is 2%, I'm going backwards 1% a year. Yeah. Bonds, the same thing. Now what this table shows is that the 4 different risks and what's the most common again. So for example, on stocks, we definitely, when we say stocks and bond funds, those are mutual funds. Does everybody know the difference between a mutual fund and a stock? Basically, a stock is you buy shares of a company. And in a mutual fund, you're buying a lot of stocks that are all pooled together. And again, some people know this stuff, some don't, but people sometimes are afraid to ask simple questions, but that's something important. So a mutual fund is a pool of stocks. They do have market risk, they do have business risk, and they do have interest rate risk, and there's possible inflation risk. And what these charts are showing is that regardless of which area you're investing in, there's going to be some type of risk. So inflation versus capital risk. Inflation risk would be your cash investments. What are money markets earning right now? Probably lower.
Yeah, most of them.
You might have to pay them to keep your money there. Municipal bonds. Capital risk would be, again, emerging markets, small cap stocks, international large cap stocks. So there's always going to be that battle between the inflation and capital risk. So there's really no such thing as zero risk. You know, people say, okay, I'm going to buy a bond because it's safe. If I buy a bond in a municipality like Stockton, California, where they went bankrupt, or Detroit, Michigan, there's risk buying a bond. Same thing if you invest in a bank. You're covered through FDIC for how much? $250,000, but a lot of banks go under. So basically, there's risk everywhere. Now, what a lot of people do is they'll stagger fixed income maturities. So fixed income maturity would be like laddering bonds. Anybody ever heard of laddering bonds? So what they do is they'll buy bonds that have different maturity dates. And the reason that they do that is to take advantage of rates as they go up. So if I buy 5 bonds, and one is a 1-year, a 2-year, a 3-year, a 4-year, and a 5-year, when the 1 year becomes due next year, I can now buy a 5-year with that money that came due, because maybe interest rates went up in that year period. But if I buy all 5-year bonds, I'm stuck in all of them for 5 years. And I'd rather have the flexibility that as each one matures, I can move it into something paying me more. Now, diversification is important. Diversification can be used to reduce both business risk and inflation risk. And this technique involves investing in different investments, not just a single investment. And the idea is that you don't want to put all your eggs in one basket. So what's common is, like, I'll have people come in to see me that worked for like General Electric or General Motors. And their $1 million portfolio is all in the stock of that company. So would that be diversified? As long as General Motors is doing well, their stock is doing well. If there's a blip in the market, they could have a problem. So that's very poor diversification. That would be one example. So here's a case study. We have John and Jane Doe. They both have $100,000, and they're going to invest for the next 15 years. So John, being the smart guy that he thinks he is, he looks for an annual return of 6% a year, and at the end of 15 years, his balance is about $245,000. Jane says, I got a much better idea. I'm going to take my money, and I'm going to divide that $100,000 into 5 different investments. On the first one, she only earned 0. On the second one, she earned 3, 6, 9, and 12. But at the end of the 15 years, Jane had $297,000 compared to her husband who only had $245,000. Who's smarter anyway, men or women? Come on, I mean, we all know the truth here. It's the women. So guys, smarten up. Listen to the wives. But that's a simple example of diversification. Now, asset allocation is a term that most people have heard, but they don't really know what it means. And it's a way to reduce your risk by being in different areas of investment. And you're diversifying your portfolio. So, for example, if I have all small cap stocks, when small cap stocks do well, my portfolio does well. But when small cap stocks do poorly, my whole portfolio does poorly. But if I have small cap and large cap, and small cap goes up and large cap goes down, or vice versa, that's called a non-correlated portfolio, and that's what I want. I don't want everything to go up or down at the same time. I want to balance it. Does that make sense?
Can you explain the difference between small cap and large cap?
Yeah, it's just the amount of money that the assets that the company owns. So if it's, I think, under 150 million, it's small cap.
Okay.
And I could be close to that number, but right around there. And small cap gives you the availability to get a better return, but you're taking more of a risk because it's a smaller company as opposed to Apple, which would be large cap. But you always want to go to a qualified professional to help do your asset allocation. That's very important. This is called the efficient frontier. And the concept of the efficient frontier, we'll see if we can make it easy to understand. It's low risk to high risk, low reward to high reward. An inefficient portfolio, see how your pie is made up of different investments, would be a high risk and lower return. On the efficient frontier, we're looking for the same return, a higher return but the same risk. So the portfolio is considered an efficient portfolio. So we want as low a risk as possible with as highest return as possible. And we want to do that without having too much overlap. I met with a new potential client last week and she thought she had a well-diversified portfolio. When we really analyzed it, all of her mutual funds held a lot of the same stock. So it was repetitive, it was redundant, there was overlap. She thought she was diversified, but she wasn't when we really analyzed the portfolio. Now, some risk management strategies, you should only change them when your objectives change. So for example, your objectives when you're working are different than the day after you retire. You want to reevaluate your objectives when you have a major life change. Quitting your job, retiring, changing jobs, a death in the family, a divorce, a marriage, children changing, grandchildren. These are all life-changing events, and you want to analyze with your professional, your advisor, probably 2 to 4 times a year. So not only for your review of your portfolio, but your personal objectives change. You want to rebalance after a certain period. Could be a year, could be every 2 years. And when you rebalance, you want to minimize potential taxes and trading costs. Now, you should select your investments by analyzing your goals and objectives, as well as your personal financial decision. Not that you're sitting by the pool and your best friend said, "Oh, I got a hot tip from my guy at the drugstore, and here's the stock that I think you should buy." And I hear that a lot from clients. You know, they got a hot tip. I would be a little leery of that. This is a simple risk management strategy that we do with clients, and this is called the bucket approach. So you have bucket 1, 2, and 3. The first bucket is the regular income. This is your conservative investments. Very little risk. And this is the income to maintain your lifestyle. So we can't take risk with the first bucket. Now the second bucket is for our major expenses. We could be moderately conservative because we're using this for future income. So bucket 1 is for today's income to pay the bills. Bucket 2 is for tomorrow's income. And the third bucket, this is one hopefully we don't need, but this is for emergencies or inheritance. Remember, everybody wants to leave that money to their kids, right? This is our moderately aggressive allocation. So we could be a little bit more aggressive with bucket number 3. So we don't want to have it all here. We don't want to have it all here. But based on our objectives and our goals, we want to divide it up between 3 buckets. because they're invested differently. We can't take a chance with bucket number one. That's not the money to use for the hot stock tip.